This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Bitcoin at $100,000. Three words that spark excitement, disbelief, and for some, fear. How did we get here? Is it sustainable? And more importantly, what does it mean for you as an investor? Today, we're diving deep into the meteoric rise of Bitcoin, the factors driving its current valuation, and why we believe crypto investments remain speculative rather than grounded in financial fundamentals. Whether you're a believer, a skeptic, or somewhere in between, stick around as we break down the facts. Let's start with the basics. Bitcoin reaching $100,000 is no small feat. It represents a nearly 400% increase from its 2023 lows. But here's the thing, it's not entirely surprising when you consider the forces at play. Bitcoin and other cryptocurrencies are designed with a constrained supply. Bitcoin specifically has a hard cap of 21 million coins, and when supply is fixed, any increase in demand pushes prices higher. In 2025, we're seeing exactly that, rising demand fueled by broader adoption and increasing accessibility. Wall Street's jumping on the crypto bandwagon with a surge of new products like Bitcoin ETFs and mutual funds, making it easier for retail investors to join the party. Wall Street's productization of crypto has been a game changer. In the past, buying Bitcoin was clunky, requiring a crypto wallet, exchanges, and navigating security risks. But now you can add crypto exposure to your portfolio with the click of a button through an ETF. This accessibility, coupled with expectations of reduced regulation under the incoming Trump administration, is creating a perfect storm for demand. But while demand continues to grow, let's not forget one crucial thing. Bitcoin's rise to $100,000 is fueled more by faith than by rigorous financial analysis. Let's face it, Bitcoin doesn't generate cash flows. Unlike stocks, bonds, or real estate, Bitcoin doesn't pay dividends. It doesn't yield interest, and it doesn't generate rental income. Its value lies entirely in what someone else is willing to pay for it. This makes Bitcoin inherently speculative. It's not backed by any financial or economic fundamentals. It's more like buying a gold bar, a store of value that only holds worth as long as others agree that it has worth. And while that faith has propelled Bitcoin to record highs, history reminds us just how volatile crypto can be. Over the last 7 years, Bitcoin has suffered multiple 50% price drops, sometimes in just a matter of days. For example, on March 11, 2020, as the COVID pandemic gripped the world, Bitcoin plummeted 38% in a single day. And while some argue Bitcoin can act as a hedge against economic disasters, the data suggests otherwise. Bitcoin's price is highly correlated with stocks. When stock markets crash, Bitcoin doesn't shield you. It often falls even further and faster. Take March 2020, for instance. The S&P 500 dropped 9.5%, but Bitcoin, that's when it cratered 38%. So much for being a safe haven. And this pattern isn't unique to COVID. It's a recurring theme. That's why we don't see Bitcoin as a viable hedge or a way to diversify against losses in traditional asset classes. Instead, Bitcoin's price movements are more akin to gambling than investing. Now let's talk about Bitcoin's utility. Crypto's unique appeal lies in its ability to combine digital convenience with the anonymity of cash. Unlike other electronic payment systems like PayPal or credit cards, Bitcoin transactions don't require a bank or government intermediary. This is particularly useful for individuals in countries experiencing extreme inflation or devaluation, where moving capital offshore might be the only way to protect their wealth. But here's the catch. In many cases, these actions are illegal. And Bitcoin's anonymity makes it attractive not just for law-abiding citizens, but also for extortionists, money launderers, and other illicit actors. This dual-edged sword highlights both the potential and risks of crypto adoption. There's also been speculation that Bitcoin could one day replace fiat currencies like the US dollar or euro. Let's be clear, we find this scenario highly unlikely. Bitcoin's fixed supply and decentralized nature make it an intriguing concept. But national currencies serve broader purposes, like enabling monetary policy and stabilizing economies during crises. Central banks need the ability to print money or adjust interest rates, tools that Bitcoin simply doesn't offer. Interestingly, the U.S. Treasury currently holds over 207,000 Bitcoin. But before you get excited, let's clarify. These holdings are the result of confiscation during illegal activities, not strategic purchases. There's no real benefit for the U.S. Treasury to hold Bitcoin as part of its reserves. The U.S. dollar is the world's reserve currency, and Bitcoin offers no advantages over traditional assets like gold or foreign currencies. So where does this leave Bitcoin at $100,000? It's important to recognize that its value is entirely dependent on demand, on others willing to pay a higher price in the future than you paid today. Unlike stocks, bonds, or real estate, Bitcoin generates no cash flow. It's speculative, pure and simple. And while that speculation can result in massive gains, it can also lead to catastrophic losses. Bitcoin's price can double or drop to zero on any given day. Our advice? Don't invest more in Bitcoin or any cryptocurrency than you can afford to lose. Treat it like a gamble, not a financial strategy. And be wary of so-called crypto analysts. Forecasting the future price of Bitcoin is like forecasting which way the wind will blow. It's unpredictable at best and deceptive at worst. Remember, every investment carries risk, but with crypto, the stakes are even higher. Bitcoin at $100,000 is a headline-grabbing milestone, no doubt. But it's also a reminder to approach crypto with caution. Speculation has its place, but it's not a substitute for solid investment strategy. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports in your inbox. Thank you very much for watching.